Good morning. My name is Joe Wishcamper. I'm Senior Counsel at Guidant Financial Group in Bellevue, Washington. Thank you for joining me this morning. Our topic is how to represent a ROBS client, what to do and what not to do. Guidant is one of the major ROBS providers in the nation. We do probably over 1,000 ROBS arrangements every year, and we've been doing this for 10 years. So during that time, we've learned a lot. We've learned a lot about exactly what should be done for a ROBS client. Conversely, we've learned exactly what should not be done. So that's the benefit of our presentation to you today. You're going to get the 10 years of experience that we've got, and I'll nail it all down for you so that you know exactly what to do. Our target audience with this presentation is the person, be it an attorney or a CPA, primarily CPAs today, the person who represents the occasional ROBS client. I'm assuming in presenting this matter that you are not an expert on ROBS arrangements. Rather, you've got the one-off situation where you have the occasional ROBS client comes through. You don't have the opportunity to develop the expertise that comes from repetition and seeing many things play out over time. So if that's you, then you're in the right place. Relax, okay? I'm going to give you a list of exactly what to do and exactly what not to do, so that by the end of this presentation, you're going to have the expertise necessary to be able to represent a ROBS client competently and keep yourself and keep that client out of trouble. I've divided the presentation into 3 areas. The first area that we're going to go through is we're going to have an overview of ROBS arrangements. What are those arrangements? What are the moving parts? How do they fit together? Once we have that overview of ROBS arrangements, then as the title suggests, we're going to have a section on exactly what to do. When that client comes in and sits down in your office, what are some of the things that you are affirmatively going to want to do so that you can check off? And the idea there is you want to sort of assess the health, the legal health of this ROBS client right out of the box. And hopefully they are healthy. If they're not healthy, then we're going to talk about some of the things that you can do to get the client healthy. Because you want to have the client healthy to start with and then keep them healthy all the way through. So that second section of what to do is focused on getting the client healthy, making sure they are healthy, keeping them healthy. Then the latter section, the third section that we're going to address, is what not to do. There are a whole category of things that we have seen CPAs do with ROBS clients that they should not have done, that create big compliance problems. So we're going to tell you what not to do. Let's start, as I say, with the overview. And there's no better place to start than the basic definition of a ROBS arrangement. First of all, what does ROBS stand for? This is an acronym that was created by our friends over at the IRS called Rollovers as Business Startups. That's their name for the industry product. Every provider in the industry has their own trade name. At Guidant, our product we call the iFinance. Other providers have different names. So the overall generic description of this product is a ROBS arrangement. And ROBS arrangements involve setting up a C corporation, and it does need to be a C corp. I'll address that later. A C corp, and that C corp then sponsors a 401k plan. And that arrangement with the C corp and the 401k plan utilizes 2 prohibited transaction exemptions. One of those PT exemptions is in the Internal Revenue Code. The second PT exemption is in the Employee Retirement Income Security Act of 1974, commonly referred to as ERISA. And so when properly done, a a ROBS arrangement enables the client to take retirement funds and use those retirement funds as startup capital to start a new business or refinance an existing business or purchase an existing business from a third party, and to do so without triggering a taxable event. Let me take this opportunity to emphasize that last line, without triggering a taxable event. I am famous for saying around our office that clients don't come to us in order to trigger taxable events. They don't need our help to trigger a taxable event. They're perfectly capable of doing that on their own. So they're coming to us so that the ROBS arrangement can be utilized without triggering a taxable event. So, as I mentioned, step number one is to form a state-specific C corporation. And again, I can elaborate later in the presentation on why it needs to be a C Corp. Let me just say at this point that an LLC won't do, an S Corp will not do, and I'll explain those reasons why later. I will also tell you, just to get it out on the table, that we understand that for most startup businesses, the last entity in the world that you would recommend if you had an open slate would be a C corporation. Rather, given the potential losses that are going to occur at startup, you want to have a flow-through entity that will enable the losses and deductions and other tax items to flow through to the client individually. Yeah, look, we get it, we understand that. However, this is an area where Congress gets to write the rules. And the United States Congress, in writing the Internal Revenue Code, has said, okay, if you want to use retirement money to form a business and capitalize a business, you can do that. You can do that. But here are the rules by which you have to do it. And one of the rules is that the entity that is involved has to be a C Corp. So there's no point in you and I arguing this matter. It's not a debatable issue. You may not like C Corp, but keep your hand away, please, from the 2553 S Corp election. This thing's got to be a C Corp. All right, so step number two is that the C Corp then sponsors a 401k plan that is a quote-unquote qualified plan. Qualified meaning that it meets the tax and ERISA requirements to receive the special tax benefits that are available under the Internal Revenue Code, primarily requirements that are in Section 401A of the Internal Revenue Code. So the client then does what I euphemistically call a tax-free rollover from their existing retirement account into the new 401k. Now, I will elaborate at some depth later in the presentation on this tax-free rollover. It's supposed to be tax-free. There's no reason why it shouldn't be tax-free. It needs to be tax-free, and in 95% of the cases it is tax-free. However, it is possible to goof this step up. And if somebody goofs up the rollover, then there's going to be Hades to pay. And I will take a section a little bit later, and I'll explain to you how it is that the rollover gets fouled up. And once you learn how the rollover gets fouled up sometimes, then you'll be in a position to advise your client on, number one, how to avoid that problem in the first place. Number two, how to detect the problem if it's there. Number three, what to do if they've got the problem. Okay, this problem is curable, okay, but you need to understand that there are some snakes in the grass on this step three with the tax-free rollover. I would also state what I consider to be the obvious here on step three, and that's that the client needs to have rollable funds, which in IRS speak means they need to have a distribution event if they're talking about money in an existing employer's account. And so if they've got money in an existing retirement account, an IRA, that's cool, that'll work. And if they've got money in an existing employer account, they may have to terminate employment in order to achieve a taxable distribution, or a distribution event, I should say. The client serves as the trustee for that 401k. And in that capacity, client then directs that the investment of their retirement account, their individual retirement account within that 401k, should be used to purchase qualifying employer securities in the C Corp. We frequently abbreviate the phrase qualifying employer securities as QES, and the transaction by which the plan purchases QES is called the QES transaction. All right, so when steps 1 through 5 have been completed, then the corporation now has the proceeds from the QES transaction down there in the corporation. The corporation is cash rich and debt free because the QES transaction is not a loan, it's an investment in the stock of the corporation, so it doesn't trigger a loan. So the balance sheet of the corporation would show the proceeds as an asset. There is no corresponding liability. So the corporation then takes that proceeds and goes and starts a new business, purchases an existing business from a third party, or can, under certain circumstances, refinance the client's existing business. So here's kind of a graphic overview of what this thing looks like. A new corporation is formed. The new corporation sponsors a 401k plan. And in guidance situation, it's a prototype plan that we license from one of the largest prototype providers in the nation. It comes with a favorable determination letter by the IRS that indicates that this plan meets the requirements for design qualification. Then the existing retirement assets are rolled into the new 401k. The new 401k invests in the business's stock, taking advantage of prohibited transaction exemptions that we're going to discuss here momentarily. And there you go. That's the way a ROBS arrangement works. I have alluded to prohibited transaction exemptions. Let me make clear what's going on. If you look at the face of this employer security transaction, the QES transaction, on its face, that constitutes a PT. So when somebody who's not familiar with the product looks at it, they say, that's a PT, that's a prohibited transaction. And the answer is, good point, good point. It is a prohibited transaction on its face. Why? Because of all the definitions of a PT, the very first one is in Internal Revenue Code section 4975 C1A, and a C1A PT is any sale, exchange, or lease between a plan and a disqualified person. So we have a sale of qualifying employer securities. We certainly have a plan involved in that sale, and the C Corporation is a disqualified person under the definitions of 4975 E2 under several different categories. First of all, it's a disqualified person by attribution from the client. Second, it's a disqualified person by virtue of being a sponsor of the plan. There's probably other categories there that make it a DP2. So we do have a sale between a plan and a disqualified person, which falls squarely within the definition of a C1A PT. However, thankfully, that's not the end of the story. If you have a statutory prohibited transaction, then on its face, what you start looking for is an exemption that would cover that transaction. And there are, in fact, two exemptions here. One of those exemptions is in the Internal Revenue Code. The other exemption is in ERISA, and they work together. They're both, corresponding. 4975 D13 says there's not going to be a prohibited transaction if the transaction falls within ERISA 408E. So you then have to chase over to ERISA 408E. And ERISA 408E says that there's not going to be a prohibited transaction if the transaction meets various compliance requirements that are laid out there for qualifying employer securities. And we can go into what those compliance requirements are. Some of them are beyond the scope of our presentation today, so I'm not going to take your time to waltz you through every one of those compliance requirements. We'll talk about the ones that you need to know about. In particular, we'll talk about the adequate consideration requirement here momentarily. But that's what's going on. So if you ever ask yourself, if you stop and scratch your head and ask yourself, why is this thing so complicated? Why are we doing what we're doing? Why are we jumping through all these hoops? The answer to that question probably is we're doing everything that we're doing in order to be within the PT exemption in ERISA 408E. Because if we're in the PT exemption for ERISA 408E, then conversely, we're within the PT exemption for the Internal Revenue Code in 4975 D13, which means that the qualifying employer securities, the QES transaction, does not melt down into a taxable event. So that's what's going on. That's the big picture of how this ROBS arrangement hangs together and why it has the moving parts that it does. So forgive me for jumping the slide there. Let's take a few moments now and talk about the laundry list of things that you affirmatively should do in representing a ROBS client. And again, conceptually, what I'm thinking here is that when you're first meeting with the client, you kind of want to assess the present legal health of this patient at the start. It's analogous to somebody who goes into a doctor's office. The doctor gathers the information so that they can assess what is this patient's condition right now. So you can't just tell by looking. Your ROBS client may be completely healthy, and hopefully is. They're in compliance with all the requirements that have been set forth for this product. That's what you hope. But you should probably check a few things to make sure that that's the case. Now, don't break out into laughter at this next slide here. Confirm the details of the client's structure. You would think that their structure is sound, but you don't know that until you ask some questions. Basic questions need to be asked. Who are the shareholders in this corporation, and what are their percentages of ownership? One of those shareholders, in fact, probably the majority shareholder, is going to be the 401k plan. And then you would expect the client to have some percentage of ownership in his or her individual capacity. Now, that percentage can range from the plan owning 50% and the client owning 50%, up to the plan owning 99% and the client owning 1%. So it just varies. We've seen it all over the map. But you need to know who the shareholders are. And probably the best way to find out who the shareholders are in that C corporation is to see the corporate stock ledger. And the client should have the corporate stock ledger. If you ask the client the question, who owns this corporation, and the client responds, well, I do. That's not a good sign. That indicates that they don't understand the product that they've got, which means that they're probably going to fall out of compliance at some point along the way if they haven't already done so. So that's why I'm saying let's pay attention to this from the get-go. Let's nail down the basics. Let's nail down the fundamentals. Who are the shareholders? Now, client may not have any subsidiary LLCs at all. And if they don't have any subsidiary LLCs, that's good, that's fine. But if there are any subsidiary LLCs, you need to find out what the ownership interests are. And again, the best answer, if there's an LLC, the best answer for who owns it is the C Corp. So the ideal arrangement is an LLC that is 100% owned by the corporation, so you've got a 100% corp-owned subsidiary here. That's the easiest, cleanest arrangement. And I would say, recognizing I'm probably talking to many CPAs today, if you've got a 100% corp-owned subsidiary, LLC, then that LLC is a disregarded entity under the tax code. It's not going to file a 1065 partnership return because it's not a partnership. It's a disregarded entity, and all the tax items would flow through to the corporation. Now, I commented that that's the cleanest, simplest way. It may be that the LLC is owned in part by the corporation and in part by other people. And you need to find out who are those other people and what is their relationship, if any, especially any family relationship, to the client. Because there is a separate issue that can come up if a subsidiary LLC is owned by a disqualified person under the code. Disqualified person is defined under Code Section 4975E2. There is a DOL advisory opinion that creates some problems, and you may have an embedded PT. There may be an indirect PT if some portion of this LLC is owned by a disqualified person. Now, how do you find out what the ownership interests are of the subsidiary LLC? Well, basically the same way you found out who owns the C Corp. You look at the equivalent of the stock ledger for an LLC. That thing's called many different labels. It could be called an Appendix A. It could be called the unit ledger. It could be some attachment or exhibit to the operating agreement of the LLC. So probably a good opening question is, provide me please with a copy of the operating agreement for the LLC. Look toward the back of that thing and find out who the owners are. All right, here's my first war story, okay? First war story of the day. We had a client who came under tax audit about 3 weeks ago. The plan came under audit. So one of the things that we do when one of our clients comes under plan audit is we confirm the details of the client's structure. In other words, we do in-house exactly what I'm suggesting needs to be done here with this slide. And there was a subsidiary LLC. However, there was trouble in River City because that subsidiary had apparently never been contributed to the corporation. That subsidiary had existed to begin with, and the plan was that the client would get that subsidiary appraised and contribute it to the corporation in exchange for stock, so that the LLC would be owned 100% by the C Corp. Unfortunately, it appeared that that's not what had happened, that the subsidiary LLC had never been contributed, but the proceeds from the QES transaction went into that LLC. So we had apparently we had a PT that was not covered by the statutory PT exemption that forms the basis for this product. So it looked like we had an absolute disaster on our hands. And we dug and we dug and we dug, and we found out that contrary to the initial impression, that LLC had been contributed to the corp. The problem was that the client did not tell the CPA that that LLC had been contributed to the corporation in exchange for stock. The CPA had no clue, and the CPA had been filing 1065 partnership returns for that LLC up to that point. So what should have happened is, upon contributing the LLC to the corporation in exchange for stock, there aren't going to be any 1065s filed anymore because it's now a disregarded entity. Well, there had been 6 years of 1065 partnership tax returns filed for this LLC after the point where it had been contributed to the corporation and was a disregarded entity. So all kinds of things were then fouled up. The LLC had filed 1065s for 6 years improperly. The C Corporation 1120 tax return was fouled up for 6 years because the tax items for this LLC should have been flowing through to the corporation instead of flowing through to the individuals. Now, bear with me while I'm trying to keep a straight face in saying all this. This client had contributed the LLC to the corp in exchange for stock, and everybody knew it except the CPA, who then produces 6 years worth of flawed tax returns. And the client is signing off on these flawed tax returns for 6 years, to the best of my knowledge. Well, the client knew that the LLC had been contributed. So you would think, wouldn't you, that they'd be a little hesitant to be signing off on 1065 partnership tax returns at that point, but they weren't. Okay, they signed off on them. So this whole mess, which is still under audit, by the way, okay, this whole mess could have been avoided, should have been avoided simply by the client telling the CPA that the LLC had been contributed to the corporation in exchange for stock and was now a 100% corp-owned subsidiary. Of course, the poor CPA had no way of knowing, so somebody's got to tell the CPA. So what I'm saying here with this slide is be proactive. Ask questions to find out who the owners are, because it may make a huge difference. And I will also say that be alert to any signs of confusion on the part of the client. If the client is confused about who owns these things, these entities, these things, that's the legal term, these things. Who owns these entities? Now's the time to sort it out, okay, before the situation gets nasty. All right, so much for, taking a look at the thermometer and checking the temperature and seeing who owns these entities. It's a simple step, hopefully won't take long, but can certainly solve problems that might develop down the road. All right, the next major thing that you're going to want to do, affirmatively want to do, is to find out who the client's service providers are. And this client, as every ROBS client does, has a significant number of service providers. So what you're trying to do here, when I say find out who the service providers are, what you're trying to do is you're trying to assemble a backup team with expertise on these ROBS arrangements, expertise that you may not have, because when an issue comes up, either you have the expertise or you need to have a service provider who's available to step in and provide that expertise. And the good news for you is that this client probably has a significant service provider team that's already in place. But you need to find out who those folks are. So, starting there at the top with the first bullet point, who was the provider facilitator who assisted the client in forming this ROBS arrangement in the first place? It might be Guidant. Then again, it might be one of the other, there's something like roughly 11 or 12 different providers out there in the market who provide these arrangements. So client knows who they dealt with in setting this thing up, and the client should be able to provide you with the name of the company, provide you with the name of the person who was their point of contact, that person's email address, that person's phone number. So find out who that is, because that person can tell you, can assist you in determining what was this thing intended to look like. If client is confused about what this arrangement entails, this first bullet point is the person to go to figure out what this arrangement was intended to look like in the first place. The second bullet point there deals with the pension record keeper. You are dealing with a 401k, which is a qualified plan, and so that 401k does have a pension record keeper. It may be that the client wants you to be the pension record keeper, and if you're qualified to do that, then fine. But it's common, it's typical, that the ROBS facilitator also has a separate program to be the pension record keeper. I know that Guidant, for example, we have a separate pension record keeping department, and for a monthly fee we provide a whole wide range of pension record keeping services, including but not limited to doing the non-discrimination testing for this plan. So the pension record keeper gathers the census data for the client, for the corporation and any control groups that happen to exist. So they're gathering the census for all that entity. They are then doing the non-discrimination testing, the so-called ADP test and the ACP test. They also will do the top-heavy testing. They'll do all this non-discrimination testing that's required under Section 401 of the Code. And they will work with the client to resolve any testing failures that happen to arise. Now, it would probably be a good idea, as long as you're finding out who the pension record keeper is, and that, by the way, that would be a separate list of persons, emails, and phone numbers, because you're talking about different people here. You should probably also ask to have a copy of the pension record keeping agreement. There is a pension record keeping agreement between the client and that pension record keeper, a written agreement that specifies the duties and responsibilities of each of the parties. it'd be a good idea for you to have that in your files. And one of the reasons why is that there may be some provision of that pension record keeping agreement that deals with audit defense. So let me give you the example that I'm familiar with. In the Guidant pension record keeping agreement, for example, we have a provision whereby Guidant agrees that it will provide audit defense in the event that the plan gets audited by the IRS. And as part of this audit defense, we agree that we will retain a tax controversies attorney to defend the plan on audit and pay the attorney's fees ourselves. In other words, Guidant is going to pay the attorney's fee to defend the plan on audit. And it may be that other ROBS facilitators have similar arrangements. I'm not sure, but the point is you need to find out if there's any kind of audit defense backup support that's available from the facilitator, and the most likely place that would be is in the pension record keeping agreement. The third bullet point involves a potential outside ERISA counsel. If you're an attorney, you may be the attorney that I'm talking about here, but if you're a CPA, there may be an ERISA counsel that's already previously consulted with this client at or about the time of formation. If so, then you most definitely want to get a contact list with that ERISA counsel. Find out that attorney's name, email, and telephone number, because you can be fairly confident that that ERISA counsel is expert with regard to ROBS arrangements. And again, the assumption here with this CPE presentation is that you're doing this on an occasional basis. You don't have constant ongoing ROBS clients, and so hence you don't have as much expertise with this as the ERISA counsel, who presumably does this all the time. So getting the contact information for all those service providers is a big, significant part of assembling the information for you that might possibly be very helpful and very important if some sort of problem arises, or for that matter, if an audit arises at a later time. I mentioned that there are a wide range of service providers, and we've talked about those, but there are other service providers that may be involved here too. For example, payroll. The client may have a payroll service provider either now or may get one in the future, and either now or at some point in the future, if a payroll service provider is added, you want to get their account number, the phone number, the customer service folks, so that you can assist the client in working out any kind of payroll problems that might arise. It's possible that client might have a bookkeeping service. Then again, if you're a CPA, maybe you're the bookkeeper. But if you aren't, then someone is probably keeping the books for this client. Find out who that someone is, again, name, contact info, because as a CPA, you're going to need to be interacting with that person. If you are an attorney, you're going to want to locate a knowledgeable, experienced CPA. Conversely, if you're a CPA, you're going to want to locate a knowledgeable, experienced ERISA attorney. As I mentioned, it may be the ERISA attorney who consulted with the client at the time of formation, if in fact there was such an outside counsel available. But if there isn't, then go ahead and start looking now for an experienced ERISA attorney, and probably one good place to start is to go back to the original ROBS facilitator who assisted the client in setting this thing up in the first place. Those folks may have contact for an ERISA attorney who can be available to consult with the client if need be. And for those of you who thought the verification job was done, no, there's still some more things to ask about and to check into. First of all, determine whether the client has any control groups. Now, I didn't put the citations in on this slide, but control groups are defined in Section 1563 of the Internal Revenue Code, and the legal impact of having a control group is laid out in Section 414 of the code. And the practical impact here is that if there are control groups, then the employees in that control group are going to be part of the census that the record keeper uses for testing purposes. So it's important that the pension record keeper be informed if there are any control groups, and presumably they are informed. The pension record keepers are very well aware of the necessity to take into account control groups when formulating the census. So they're aware of this, but the client may not have told the record keeper. It is entirely possible to form control groups after the fact. So there may not have been a control group at the start, but here we are 6 months, a year later, and there may be control groups now. And so one of the basic questions, if client does have a control group, is does the pension record keeper know about this? And if there's an ERISA counsel, does the ERISA counsel know about it? Hopefully the answer is yes. These service providers do know about it. But if they don't, then client needs to connect with the pension record keeper, tell them of the control group, give them whatever data they need in order to be able to start taking that into account. And depending upon the terms of the plan, it may be that those control group employees need to be offered admission to the plan, the right to participate in the plan. So the pension record keeper should be very familiar with the degree to which those control group employees need to be included in the actual operation of the plan. All right. Another bullet point that I keep running across is that a CPA can assist the client in determining what constitutes a reasonable salary. Clients seem to struggle with this. So here's an area that the CPA can provide some really significant help with. And that could involve determining the nature and scope of the services that the client is providing to the corp, assisting the client in making a determination of what sort of salaries are being paid in the local area to similarly situated businesses. My third bullet point there is to check to make sure that the client has systems in place to maintain compliance going forward in areas that constantly come up. Financial books and records. Is the client keeping financial books and records? They should be. And are they properly set up? There's lots of software that's out there available on the market these days that is available to help with this. And so I mentioned QuickBooks just as one. There are certainly other types of accounting, bookkeeping software that's available. And client needs to have something to help keep track of their books and records. You might also take a look and confirm that an appropriate chart of accounts has been created. You know, the sort of the easy step is for the client to take the default chart of accounts that is proposed by the software. And that may work very well, at least starting out, but then once the business sort of matures a little bit, there may need to be other charts of accounts that are created. In terms of tax preparation going forward, you know that you're going to have to file an 1120 for the C corporation. So go ahead and get the framework in place for being able to do that. For example, get the corporation's EIN. Now, I say in 1120, resist the temptation to file a 2553 to make an S selection. This thing can't be an S corp as long as there are any QES outstanding. You're also at a minimum going to want to be filing the 941 for the FICA and FUTA withholdings. If there is a subsidiary LLC and that subsidiary is not a single member but rather is a multiple member LLC, then you would need to be filing a 1065, which makes my blood run cold for reasons of the war story that I told you. So if you're going to be filing a 1065, make sure that you check and recheck with the client to determine who the owners are for that multiple member partnership. All right, this is the point in the presentation where I get to entertain you with the saga of the miscoded 1099-R. I mentioned earlier in the presentation that the rollover from clients' retirement funds into the 401k is intended to be a tax-free rollover. And it is. And in most cases, it is. However, if that thing falls off the rails, let me explain to you how it falls off the rails and what you as the CPA or attorney for the client need to know. The procedure starts for a rollover when the client contacts their outgoing custodian. The outgoing custodian for the IRA or outgoing custodian for the prior employer plan. So the outgoing custodian has a rollover form, and that rollover form unfortunately is not common across the industry. Every custodian has their own rollover form, and the client either gets a hard copy or downloads a copy of the rollover form off the internet, gets it some way. And these are usually multiple page forms, and they've got a whole bunch of different boxes to check, and they're not particularly user friendly. So it is possible for the client to mistakenly check the wrong box on the outgoing custodian's rollover form. And it is possible to check a box that tells the custodian that it's a taxable distribution, when in fact it's supposed to be a non-taxable rollover. Or more precisely, in most cases, a non-taxable direct trustee-to-trustee transfer. So the client can check the wrong box. Now, these custodians are fairly diligent, so they do what the client tells them to do. And so if the client tells the outgoing custodian that this is a taxable distribution, when that's a mistake, it's not supposed to be, the outgoing custodian doesn't know that it's a mistake. the outgoing custodian does what they're told to do, and they issue a taxable distribution. Now, welcome to the introduction of Form 1099-R. The outgoing custodian prepares this report, this 1099-R, and sends the primary copy directly to the IRS to tell the IRS that there's been a distribution and to tell the IRS what the tax treatment is for that distribution. So the IRS gets a copy of this 1099-R, and then the client gets a copy also. Now, the timing on the issuance of this 1099-R involves some delay. And so this 1099-R gets issued during the first several months of the next taxable year. So if client were to do a rollover in, just by way of example, September of 2014, then in January, February, or March of 2015, this 1099-R is going to be submitted. So client will get, in this hypothetical, client is going to get their copy of this 1099-R in January, February, March of 2015. Now, at this point, the games begin, because it's been quite a while. See, now they did the rollover in September of 2014. Here they are, perhaps March or so of 2015. It's been a number of months. They haven't completely forgotten about this, but they certainly aren't paying a lot of attention to detail. Well, unfortunately, this is a situation where somebody needs to pay attention to detail. The client probably remembers the amount of money that they rolled, and that's listed there in box 1. So if they open this envelope up and they see a tax form, their eyes are probably going to glaze over, but if they look at it at all, they see that it's got their name on it, and they happen to look at box 1, see that the correct amount of the rollover is there, they call it good. Unfortunately, the most important box on this form is buried down there in box 7. Okay? Box 7 on the 1099-R has a code, and that code, which is unintelligible to mere mortal men and women, tells the IRS whether this was a taxable distribution or not. And so what you want to see in box 7 is code G as in golf, or G as in good to go. All right? Code G as in golf, good to go, says that it's a tax-free rollover, basically a direct trustee-to-trustee transfer. So that's the code that you want to see in box 7. Let me tell you the code that you do not want to see. Okay? You do not want to see code 1. Code 1 is the fatal kiss of death in this situation. It says that there's an early distribution, no known exceptions. No known exceptions. In other words, tax me, baby. So, not good, all right? The client would have to go to a separate document in order to get these codes. The codes are not available anywhere on Form 1099-R, so you'd have to download instructions off the IRS website, which most clients are not likely to do. So they've just got no way of knowing this. So where I'm going with this is that you should tell the client, affirmatively tell the client, okay, Mr. Client or Ms. Client, you can expect to receive a 1099-R from the outgoing custodian sometime during the first several months of this next upcoming taxable year. When you get that 1099-R, look in box 7. And if there's anything in box 7 other than code G, contact me immediately. Let me repeat that. If there's anything in box 7 other than code G, contact me immediately. And even better still, take and make a copy of that 1099-R and send it to me. Okay? So you have them send it to you, and you can take a look at box 7 as well. Don't even trust them to look at box 7. Just, tell them to do that, but also tell them to send you a copy of that 1099-R. When I said send it to me, don't send it to Joe Wishcamper, okay? I don't want to see these 1099-Rs. I'm referring to you in the sense of you, the participant, you, the attendee in this seminar. All right, so let's get back on track here. The reason why it's important to know is that if there's a problem, the sooner you find out about the problem, the easier it's going to be to solve. One other thing that I want to mention before I forget is that not only should the client look for this 1099-R when it comes around, but the client, you should affirmatively tell the client to complete the lines on the rollover form so that you've got the 1040 tax return correctly filled out. Now, I've got here, for slide purposes, the most recent version of 1040 that I could download off the IRS website. That's for tax year 2013. And on the 2013 1040 tax return, lines 15 and 16 were the places for the client to record the rollover distribution. And by doing that on their individual tax return, that will help in the event that there's a miscoding problem. Because here the client is contemporaneously telling the IRS that it was a tax-free rollover. If it turns out that you've got a miscoded 1099-R, then this is some degree of substantiation that the client believed it was a tax-free rollover. Now, client needs to understand that if there was or is a miscoded 1099-R problem, then the first time the client's probably going to know about it will be when they get the 1099-R and look in box 7. If they fail to do that, then the next time that they're going to know about it is when they get what I euphemistically call the Dear Deadbeat Taxpayer letter. And now it's not actually named that, okay? I'm making a joke, okay? It's not, the IRS doesn't really say Dear Deadbeat Taxpayer, but bear with me. I think I get the drift of this thing. So the Dear Deadbeat Taxpayer letter goes something like this. Dear Deadbeat Taxpayer, we received your 1040 and we note that you somehow failed to record the $100,000 rollover that was that you did. And so we have taken the convenience to be able to help you. We have recalculated your taxes for you, and you owe the following additional tax plus interest, probably owe the 20% substantial understatement penalty, and all this wraps up into one beautiful little number. And okay, so it goes from there. Client gets that Dear Deadbeat Taxpayer letter. That's the first notification of the problem, unless client catches it ahead of time off of the miscoded 1099-R. So we have had clients respond in different ways. First of all, everybody freaks out, okay, when they get this. The client goes absolutely ballistic. Client doesn't know that the problem is the result of their foul up with the checking the wrong box on the outgoing custodian's form. Rather, they blame anybody and everybody for creating this problem because they don't understand that they did anything wrong. So the important thing is to notify you as their service provider, either you as their attorney or you as their CPA, immediately if they get any such communication from the IRS or the Department of Labor, especially a communication involving the 401k. Now, I will tell you that we have been able to resolve this miscoded 1099-R problem 100% of the time. So this problem can be cured. If it was a direct trustee-to-trustee transfer and it's simply a miscoded 1099-R problem, we can get the problem resolved. And you can get the problem resolved. And the client's service providers can get the problem resolved. But only if they've got notice about this. So we've had clients sit on these letters and ignore them. I'm not sure, but I think some of them have gone and buried them in the backyard. It's the ostrich approach, okay, which is a very bad approach for dealing with communications, unpleasant communications from the IRS or DOL, because the situation is not going to go away. It's not going to get better. To the contrary, it's going to get worse, because with every passing communication that gets ignored, and with every passing communication for which client fails to respond, client's legal rights diminish. So at the very start, client has full, plenary rights that would enable this problem to be resolved and basically make the problem go away. But over time, those rights diminish. And so this is not an area where the human tendency to procrastinate is a good thing. So you just flat tell the client if they get any communication from the IRS, especially one involving this plan, to notify you immediately so you can do something about it. Okay. Take a deep breath. I'll take a sip of water here. We've covered things that you affirmatively should do. Now let's wade into the laundry list of things that you should not do. And depending upon the amount of time that I've got available, I'll go into some degree of depth to explain why you should not do it. And, I can run through the bullet points here on things you should not do. I can do that in 5 minutes. But if you don't know why you shouldn't be doing something, then the impact is not there. So bear with me here. First of all, I think you probably got the drift at this point that I do not want you to be making any S selection for this C corporation while there's any QES still owned by the 401k. And the reason for that is that the PT exemption on which this entire product is based the PT exemption under ERISA 408E and the corresponding parallel exemption under 4975 D13 of the code is simply not available if you have an S Corp with a employee shareholder who has a 5% or greater ownership interest. And in almost every situation for these ROBS arrangements, you do have an employee shareholder with a 5% or greater ownership interest, either directly or through attribution. So the bottom line on it is that the exemption on which the entire product is based is lost. It goes flapping out the window if you make a 2553 S election. So don't do it. Okay? I mean, I hate to be so categorical with you, but don't do it. Okay? The citation for that loss of exemption is there on the slide in that second bullet point, Code Section 4975 F6. So I would encourage you to act in an enlightened manner. Now, that's not to say you can't make an S election after this ceases to be a ROBS arrangement. Okay? It is possible down the road that all the QES could be redeemed from the plan so that there is no QES anymore. If there's no QES anymore, then fine. Okay? But as long as there's any QES still owned in that plan, thou shalt not tinker with the C corporation by making an S election. All right, the second broad thou shalt not is don't go making any structural changes in the client's ROBS arrangement without first consulting with a knowledgeable, experienced ERISA counsel who is expert on these things, does know where the bodies are buried, and does know where the compliance boundaries are. The concept is this. The ROBS arrangement will work. They are legal, they will work without triggering a taxable event, provided you stay within certain very narrow compliance boundaries. You take one step outside these compliance boundaries and you can trigger a taxable event. So it's important not to take steps outside the compliance boundaries. And almost all, not all, but almost all, involve making some kind of a quote-unquote structural change in the arrangement. So don't make any structural changes without consulting somebody who can tell you whether you're about to step across a compliance boundary. Now, it may be that the structural change is perfectly okay, but you don't know that unless you have the expertise. And our assumption here with this presentation is this is not your bag. You know, you do the occasional ROBS client, but you don't have a full practice with these. So let's take a look now at examples of structural changes. Attempting to make an S election. I think I might have mentioned that a time or two before. Don't do that. Okay? Adding or subtracting subsidiaries. Well, it certainly may be possible to add or subtract subsidiaries without a problem. But then again, there are potential issues that can come into play. Let me touch on a few of those. One of the compliance requirements for a ROBS arrangement is that it has to meet the operating company definition within the Department of Labor's Plan Asset Regulation. The citation for that regulation, not on the slide, but it's ERISA Reg Section 2510.3-101C, as in Charlie. So whatever the activity is, it needs to meet the operating company definition. And part of the operating company definition is that the primary activity needs to be conducted directly or through a majority-owned subsidiary. So if the primary activity is conducted through a majority-owned subsidiary, ideally a wholly owned subsidiary, that's fine. But if client thinks that they're going to pursue this business activity through a 50-50 subsidiary, 50% is not a majority. You and I had the same math teacher, right? Okay, 50% is not a majority. It's got to be 50% plus a scintilla. And so adding a subsidiary, one of the things that needs to be done is to make sure that the result, the desired result, is going to meet the operating company definition. The second category there involving subsidiaries is that it needs to meet the compliance requirements of DOL Advisory Opinion 2006-01A, which is a real mess, and a full discussion of 2006-01A is way beyond the scope of this seminar. But bottom line on it is, if you have any disqualified persons who are individual owners in those subsidiaries, you may be triggering an indirect PT. So you need to have somebody who understands 2006-01A take a look at it to make sure you're not crossing any compliance boundaries there. The third bullet point involves changing the line of business or adding a different line of business. This too harkens back to the DOL's plan asset regulation and the definition of an operating company. The definition of operating company includes any product or service other than the investment of capital. So if the line of business, the primary line of business for the corporation, is the investment of capital, you've got a major boo-boo. You've got a violation of the plan asset regulation, which is going to involve a PT every time the client touches the assets of the C Corp. So this again is something that you wouldn't necessarily know and you wouldn't appreciate the significance of, but contact that knowledgeable ERISA counsel to make sure that you're not running afoul inadvertently of the requirement that the line of business be something other than the investment of capital. But let me also add, it's not at all clear what constitutes the investment of capital. For example, how about pursuit of the factoring business? There is a franchise out there, there's actually multiple franchises out there that involve the business of factoring. So is factoring the investment of capital? There's no clear guidance on that. We found out by seeking an informal, non-binding readout, opinion, if you will, from the DOL on whether factoring business constituted the investment of capital, and they told us that it very well might constitute the investment of capital. They were a little uncomfortable with it. So when you change the line of business, you need to make sure that you're not adding something that could be the primary activity involving the investment of capital. Another bullet point involves transfers of stock in the corporation. One of the major compliance requirements in ERISA 408E is that the plan should pay no more than fair market value for its stock. The plan can pay less than fair market value. There's no rule against the plan getting a bargain, but the plan cannot pay more than fair market value for its stock. That's called the adequate consideration requirement. And so we take a conservative view of that as long as the plan is holding any QES at all, then you would not want to dilute the ownership interest of the plan by issuing stock below fair market value to other persons. So if you're going to have any transfers of stock in the corporation while there's QES outstanding, you need to make sure that those transfers are for fair market value. And that may require an appraisal. We don't require an appraisal at the start if there's a arm's length transaction between unrelated parties, because that by definition constitutes fair market value. But after you operate this corporation for a year, the likelihood is that there's been a material change in the value of the corporation, and hence a material change in the value of the stock. So just because you transferred stock for $10 a share a year ago doesn't mean that the fair market value is still $10 per share. So it may require an appraisal. The next bullet point involves attempting to add a second class of stock, usually an attempt to add preferred stock. Well, bear with me on this one. The problem is that there's a requirement for an annual valuation of the stock. And that stock valuation, that annual valuation, has to be entered on a specific line item on the 5500 tax return. And so I will tell you that getting the client to value that stock is an exercise in tooth extraction. It's very difficult. Clients don't want to do it, and yet they have to. And so getting it done is tough, I will tell you. We've encountered significant, tremendous problems in trying to get clients to value that stock. So I have absolutely zero interest in adding a second class of stock on top of the first class, because in the Internal Revenue Code, under the regulations, there's some discussion about how do you know when you have a second class of stock, and the answer is it has different economic rights. Well, it stands to reason. If the second class of stock has different economic rights, then it would have a different value, wouldn't it? So if you've got a second class of stock, then you've just doubled the valuation challenges presented to the client. And client can hardly handle the burden to get one class of stock valued so that it can be put onto the 5500, much less two. So we're just not going to go there. We're just not going to tolerate the existence of a second class of stock, which will create all kinds of adequate consideration problems because of the difference in value. Related to adequate consideration is the next point, involving the issuance of stock options. I mentioned we don't want to do anything that's going to water down, dilute, if you will, the value of the stock paid by the plan. And so all of these arrangements are such that they can and will dilute the value of the stock held by the plan. So I realize that there are certain industries out there that just revolve around stock options. For example, high-tech startups in Silicon Valley in California. Okay, every one of them involves stock options. I know that, and so there are just certain types of businesses and industries for which a ROBS arrangement is not suitable. If they're going to have to use stock options and sweat equity to issue stock, they probably shouldn't be in a ROBS arrangement in the first place. Kind of a bottom line. All right, our next bullet point involves a change of the client's status so that they're no longer a bona fide employee. Let me explain what this one entails. Fundamental to the definition of a qualified plan is something that's known as the exclusive benefit rule. Okay? And the exclusive benefit rule comes directly out of Internal Revenue Code Section 401A, the opening language. And it's something like it's a trust for the exclusive benefit of the employees or their beneficiaries. And so the point is that anybody who rolls money into the plan needs to be a bona fide employee. Can't have any independent contractors in that plan, and you can't have any silent investors. We encounter this silent investor problem all the time, where the party that's rolling the money in never has any intent to be a bona fide employee at all. They want to fund this business for their spouse or for their offspring, but they don't have any intent to work there themselves. So they're not going to meet this bona fide employee requirement, which means they're going to flunk the exclusive benefit rule. I believe it's called the exclusive purpose rule under ERISA. And so that can disqualify a plan. So if there's a change in the status, it needs to be reviewed to make sure that this change of status is not going to bust the exclusive benefit rule. Now, it's not to say that client can't retire. Client certainly can retire. But it is important that there be an attorney look at the facts and circumstances to make sure that this thing was not an exclusive benefit rule violation in the first place, or that this change of status is not going to trigger such a violation. The next bullet point makes reference to any purchase of real estate from which the corp will operate. That is DOL Advisory Opinion 2006-01A. Our reading of that advisory opinion is that it would be a PT for the corporation to occupy real estate that is owned by the client individually. And so if client owns the real estate individually, the corp should not operate from that real estate. Otherwise, there can be a very high risk of a PT. So again, that's something that an expert would need to look at and review. The next to the last bullet point involves the sale of client's business. It's certainly possible to sell client's business. That's not an issue. The question is, how will the sale be for all cash, in which case no problem, or will the sale be for part cash and the remainder of the purchase price paid out in a promissory note? Where you're going with this is you want to, if you're going to sell the business, if a client's going to sell the business, they want to be able to terminate their plan because they don't want to, have what would amount to an orphan plan. There's not going to be a employer business sponsor for that plan anymore. So you want to be able to terminate the plan if the business has been sold. And that means that all the assets of the plan have to be distributed and a final 5500 filed. Well, that can take place with no problem so long as it's an all-cash sale. But again, if it's not all cash and there's going to be some payout of that purchase price over time, you would like to have an attorney who's experienced in terminating plans take a look at the purchase and sale agreement, because rather than have one promissory note to the corporation for which the payout is going to occur over some period of time, maybe even years, you can typically negotiate with the purchaser so that there will be two promissory notes. One promissory note in the ratio of ownership of the plan, the second promissory note payable in the ratio to the ownership of the other shareholders. And so the plan will get its promissory note, and you can then roll that promissory note out to a self-directed IRA. And at that point, you will have distributed all the assets of the plan, and you can file the final 5,500 and get out of town. So that's cool. That's what you want to do. So the sale of client's business can either be a mess or it can be straightforward depending upon how it's structured. Final bullet point there involves taking out an SBA loan. And there's no problem in taking out an SBA loan. I would say probably a good 20 to 25% of our ROBS clients do take out SBA loans, but there needs to be some understanding that there is a waiver required in taking out an SBA loan. And the reason for that waiver is that there is a requirement in IRS regulations that any 20% or greater shareholder needs to execute a personal guarantee of the loan to a borrower corporation. Well, one of the shareholders here is the plan. And if the plan were to issue a personal guarantee, then that would constitute a prohibited transaction. It would be a 4975 C1B loan or extension of credit violation. So the SBA understands this. They've got a procedure in place to issue waivers. So that's good. All right, let me wrap up, and then I want to answer one quick question before we go. You can do a good, solid, competent, capable job of representing ROBS clients even if you don't have expertise on that arrangement. And the way you're going to do that is get your network in place of knowledgeable, experienced service providers, those who do have the expertise, and consult with them prior to events that could trigger compliance problems. I would also encourage you to take advantage of other ROBS-related CLEs and CPEs here at Lawline. They've got an excellent library and inventory of seminars that cover ROBS arrangements, and so if you're interested in knowing more about it, you're in the right place. Okay, I got one question, and I'm going to read it, paraphrase it. Okay, the question is, okay, if you've got these subsidiary LLCs that are part of the ROBS arrangement, if it's a single member LLC, they understand how that works. But can additional members be added in the future? And the answer is yes, you can add additional members to that LLC in the future, but you've got two compliance requirements that you have to meet. Number one is the adequate consideration requirement. So it would be necessary to get that CLE appraised, the LLC, forgive me, you need to get that LLC appraised so that you would know what the ownership interest should be to correlate with the investment that this third party is going to make. So the appraisal requirement / adequate consideration requirement needs to be met. The second thing that you want to do is you want to vet this proposed arrangement so that you do not have any DOL advisory opinion 2006-01A problems. Translation is if the person or persons, the additional members, are not disqualified persons under the definition in the Internal Revenue Code, you're good to go. If they are disqualified persons under the definition in the code, you may have DOL advisory opinion 2006-01A issues. So vet those two requirements first before you add additional members. Okay, that's the only question that came through to me. I want to thank you for your time today. This is, a subject matter that has a lot of moving parts to it, and so it's easy to get confused. I hope that I've simplified this down for you so that you've got a do list and a don't list. Okay, review those things and you should do fine. You will do fine. You will do a good job for your client, and you will nail this thing with a happy client who is compliant going forward. Thank you very much.